Creating a balance sheet is a critical process for any company as it provides a snapshot of the company's financial position at a specific point in time. Here is a detailed, step-by-step guide to constructing a balance sheet. 1. Understand the balance sheet structure. A balance sheet is divided into two main sections: assets on one side and liabilities and shareholders' equity on the other. The basic principle is that the total value of assets must equal the total value of liabilities and shareholders' equity. This equation is the foundation of the balance sheet. 2. Gather financial information. Collect all relevant financial data from the company's accounting records, including details on cash balances, accounts receivable, inventory, property, equipment, debts, and equity. Accurate and up-to-date information is essential to ensure the balance sheet reflects the true financial condition of the company. 3. Categorize assets. Assets are typically classified into current and non-current, or long-term, assets. Current assets are those that are expected to be converted into cash or used up within 1 year, such as cash, accounts receivable, and inventory. Non-current assets include property, plant, equipment, and intangible assets like patents and trademarks. Each asset category should be listed separately with its respective value. 4. Determine the value of current assets. Start by listing current assets in order of liquidity, meaning the ease with which they can be converted into cash. Cash itself is the most liquid asset and should be listed first. Following cash include accounts receivable, inventory, and other short-term assets. The value assigned to each asset should be based on the most recent financial records. 5. Assess and list non-current assets. Non-current assets, also known as long-term assets, are those that will provide value for more than 1 year. These might include land, buildings, machinery, and equipment. Each asset should be listed individually with its current value, which may involve calculating depreciation for tangible assets or amortization for intangible assets. 6. Identify and categorize liabilities. Liabilities are also divided into current and non-current categories. Current liabilities are obligations that the company expects to settle within 1 year, such as accounts payable, short-term loans, and accrued expenses. Non-current liabilities include long-term debts like bonds payable and mortgage loans. List each liability category separately and include the exact amount owed. 7. Calculate and list current liabilities. Start with current liabilities, which are obligations the company needs to settle within the next year. These might include accounts payable, wages payable, and short-term loans. Each liability should be recorded at the amount that will be paid in the future, based on current agreements or invoices. 8. Assess and list non-current liabilities. Non-current liabilities, also called long-term liabilities, include obligations that extend beyond 1 year, such as long-term debt, deferred tax liabilities, and pension obligations. These liabilities are listed separately, and their values are based on the current amounts owed, factoring in any interest or other terms. 9. Determine shareholders' equity. Shareholders' equity represents the owner's claim on the company's assets after all liabilities have been settled. It includes common stock, retained earnings, and any additional paid-in capital. The value of shareholders' equity is calculated by subtracting total liabilities from total assets. This section should also reflect any dividends paid out or shares repurchased by the company. 10. Ensure the balance sheet balances. The final step is to verify that the total assets equal the sum of total liabilities and shareholders' equity. If the balance sheet doesn't balance, it indicates an error in recording or categorizing the financial information. Double-check all entries, calculations, and classifications to ensure accuracy. Once balanced, the balance sheet provides a clear picture of the company's financial position. These steps provide a comprehensive approach to constructing a balance sheet, ensuring that the company's financial data is accurately represented and properly classified. The balance sheet is a vital tool for both internal management and external stakeholders, offering insights into the company's financial health and guiding future financial decisions.